Good afternoon, everyone, and welcome to this webinar, this Nadex webinar on knockouts and call spreads. I want to thank everyone for joining me today. Hopefully, everyone gets some benefit out of this session. Before we get going, I got to take care of some housekeeping items, and then we're going to jump into it. First up, this webinar, as are all of our webinars, are sponsored by our compliance department. So I do need to share this disclaimer that trading involves risk and may not be appropriate for everyone. That any transactions you make and any trading decisions you make are solely your responsibility and at your own risk. And lastly, this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I am doing this for your education purposes. That will become abundantly more clear when I jump over to the platform and demonstrate some of the things that we discuss, because then I will be showing some trading going on and there's no logic to it. I'm just going to be demonstrating how it works. So please do not take that as any type of trade recommendation. As a quick introduction, my name is Todd Rich. I am with Nadex. I'm the head of education. And if you're wondering how I ended up here at Nadex and at IG Group, this is a continuation of some extensive experience in the trading and financial services space. I started my career with Anderson Consulting, but then moved to Chicago to trade on the trading floors. And then I migrated off of the trading floors and started working for exchanges and brokerage companies, namely Eurex. If you're not familiar with them, they're owned by Deutsche Börse, a very large futures exchange out of Frankfurt, Germany. I then came back and started working for some of the exchanges here in the United States, Boston Options Exchange, which we renamed BOX, the New York Stock Exchange for a number of years before E-Trade hired me away. And then I had the opportunity to join IG Group as they started to grow in the United States. And IG Group does own Nadex as well as some other properties in the United States, namely Tasty Trade, if you're not familiar with them. I do have a BA from UCLA as well as my MBA from UCLA. So I think it's just kind of nice for people to get an idea of who the heck is talking. Now, what are we going to be talking about today? And there are some, if you notice on the right-hand side of your platform, actually, you know what? I'm going to go through the agenda real quickly, but notice there's a little question mark on the right-hand side when you're looking. If you click on that, you will be able to type in questions. I would like you to do that. If you've got any questions, the high likelihood that if you've got a question, someone else has a similar question, and I want to make sure I'm getting to everyone's concerns as we go. And when we move over to the platform and start demonstrating, if you wanted to type in a product that you'd like to see for me to demonstrate on, by all means, please feel free to do that as well. The other thing I want to mention, this is being recorded. You will get an email on how to access the recording, which hopefully will be available later today. If not, it will be available tomorrow. What I plan on talking about today is I am going to spend just a minute or two on who is Nadex. I think it's important to understand who we are and why Nadex is around and why you've probably come to Nadex or you're looking at coming to Nadex before we jump into knockouts and call spreads. And if you're not familiar, we also have binary options, and we do sessions just like this specifically to binary options, which is what drives most people to Nadex. But then they find out we've got these really cool things called knockouts and call spreads. And sometimes you might prefer, or there might be market setups that are more conducive to trading one of these products. I will talk about what knockouts are. I will talk about how they work. I will talk about the risk and reward of them, as well as how much money you have to have in order to trade them. And there was a method to the madness. You'll understand after I kind of go through it all. But once you understand knockouts, I think call spreads make a lot of sense. I find that once you understand knockouts, moving to call spreads or understanding call spreads is that much easier. And then, of course, as I mentioned, there will be a practical demonstration. So I will show you on the platform. And I'm hoping to spend a little bit of time on the platform just so you can become familiar with how you would access them and how you can see what knockouts and call spreads are. We've tried to make it as pretty and clean and easy to understand on the platform, but it helps if you have a basic foundation of what the products are before we start showing you and you go, wait, go back a bit. So first we're going to go through a slide deck, then we will jump over to the platform. So let's start off with who is Nadex and why so many retail customers are finding their way to Nadex. And Nadex it's an acronym. In the financial services industry, we love our acronyms, and it's an acronym for North American Derivatives Exchange. Now, what is Nadex? It is a regulated exchange. Now, I've highlighted regulated, and that is really important. Now, we are regulated by the CFTC, another one of our wonderful acronyms in the financial industry space, and it's just short for Commodity Futures Trading Commission. Now, that is a regulatory body. On the securities side, there's the SEC, the Securities Exchange Commission. We are regulated on the future side, the CFTC. Now, the reason I really call that out is mostly around binary options. There are other binary option providers out there in the world that you might be able to access over the internet. And a lot of people come to Nadex because they're looking up binary options, and then they'll find these other binary option providers. And with those binary option providers, and if you do some research, you'll hear about all these nefarious behaviors that happen in the binary option space by some exchanges and some brokers, and it's odd and weird. At Nadex, none of those challenges apply. We are a proper regulated exchange in the United States. We have regulatory oversight by the CFTC. We have to adhere to all the rules and laws of the United States. And so when you hear about people having problems not being able to access their money or some weird behavior happening in the markets, that simply is not the case with Nadex. We've got regulatory oversight, we are audited, and we are monitored, and we cannot and we do not violate any of those rules. So when you do look at binary options, I would say if you're looking at an offshore exchange, my only advice would be caveat emptor, buyer beware. If you had any problems, challenges, and wanted some type of recourse, there would be no place to go to. But Nadex is regulated by the CFTC. Now, what does Nadex do and why are retail customers here is we designed contracts specifically for the retail trader. Now, what does that mean? The retail trader. We've got contracts that have a very low cost to enter a trade, and they all have clearly defined risk before you get into the trade. So there are no surprises. You know what you're getting into before you enter a trade. So when you hear about retail traders trading some other products and then you hear these horror stories where they completely blew up and they lost more money than they had, that simply can't happen at Nadex. What we find is a lot of brand new people, individual retail traders who want to access price action in the markets. They really like coming to Nadex because we've got these binary options, we've got these knockouts, we've got these call spreads that are very low dollar. You do not need thousands of dollars. You can do so with hundreds and potentially even tens of dollars. And you can get into a position, you've got an opinion, and you can trade, but you know what your risk is going into the trade. So there are no surprises by something happening and then you having to put more money into your account or margin calls. And I will go through all that. That kind of scenario does not happen at Nadex because of the very nature of all of our products having very clearly defined risk. Oh, you know what? And before I move into the products, I do like to put this out there. A lot of retail traders like to trade with their friends. They'll trade in groups. And if you are around Nadex and you've been at Nadex for a while and aren't familiar with our Refer a Friend program, or if you're brand new, if you've got a live account, you have to have a live account. This won't work if you only have a demo account. But if you have a live account and you invite your friends to join and you have your own very specific this link would be catered to you, and you sent it to your friends and your friends signed up using this link, and they signed up and they placed 5 trades within 30 days of applying for their Nadex account. we'll give them $100 into their account to trade with. We'll even give you $100. So it's sort of like what Oprah, you get $100, you get $100, everyone gets $100. You can do that with up to 10 of your friends, and you would end up having $1,000 in your accounts to trade with, And again, it can be a little bit of a social activity where you trade with your friends. So I just wanted to put that out there. Now, let's get into it. Let's talk about knockouts. What are knockouts? And a knockout is a contract that has a set range. And the set range has two price levels. It has a floor and a ceiling. Okay? And the value of a knockout contract will move directly in line with the underlying market between the floor and the ceiling. So with knockouts, and we've got knockouts on equity indices, we've got knockouts on foreign exchange, we've got knockouts on commodities like gold and oil and silver and natural gas. And for example purposes, I think I'm going to use oil and gold because they've been volatile lately. But let's just take oil for an instance. A Nadex knockout in oil, it is a Delta 1 product. The price of the underlying contract, the price of the knockout will move directly, point for point with the movement of the price of crude oil futures. So that's why we call it a Delta 1. Different than if you're familiar with binary options where you're trading the probability of an event occurring. And we'll talk about the differences with call spreads. With knockouts, it is straight up, you are trading the price of the underlying market. And just like any other product that you might be familiar with, like if you're trading stocks, if you think oil was going higher, you would simply buy a knockout. If you thought oil were going lower, you would sell a knockout. Now, that sounds a little weird to some people. They say, how can I sell something if I don't own it? And this goes to the very top line that we've got a contract. You're not actually physically trading oil. You are trading the price of oil. You are speculating on the price of oil. If you bought a knockout, you're speculating the price is going to be higher. If you sold a knockout, you're speculating that the price of oil were going to go lower. So you're simply taking either a short or bearish position on oil if you sell a knockout, and you're taking a long or bullish position if you were to buy a knockout. And it's just that straightforward. It's pretty intuitive. You buy it if you think it's going up, you sell if it's going down, and the price of the knockout will move directly in line with the underlying market between the floor and the ceiling. Now, how does a knockout work? And a knockout will expire in one of two ways, either by price or by time. Now let's talk about that. First we're going to talk about price, and we call this price triggered settlement. If the price of the underlying index, so if oil were to touch the floor or the ceiling of that knockout, you would be knocked out of your trade. That is why they're called knockouts. So if you buy a knockout and it goes up and touches the ceiling, you're knocked out of the trade. Now, if you bought it and it touched the ceiling, you made a profit. If you buy a knockout and it were to go down to the floor and touch the floor, you would get knocked out of the trade. Your position expires, it's over, that knockout is over. And if you bought a knockout and it went down to the floor and you got knocked out because you bought it and it went down, you would experience a loss. And it would be vice versa if you sold a knockout. If you sell a knockout and it were to go down to the floor, hey, I sold a knockout, I was taking a short or bearish position on oil, for example, and it went down and it touched the floor, boom, I'm knocked out, and you experienced a profit. If I sold a knockout and it went to the ceiling, it went the wrong way. I sold it, it went the wrong way. I'd get knocked out if it touched the ceiling. Now, it doesn't matter how high oil goes. it can keep going high. You cannot lose anymore. You've been knocked out once it touched the ceiling. Now, the other is also true. If I sell a knockout and it goes down to the floor, I get knocked out for a profit. If oil were to keep going lower, I couldn't make any more. I've already been knocked out of the trade, but that's okay. You made a profit. Now, the other way a knockout can expire is through time, and we call that time-triggered settlement. Excuse me. I just swallowed a bug or something. Give me a second. Sorry about that. Now, if, and this actually is the very first question someone would normally ask, okay, I traded a knockout, it trades between the floor and ceiling. Now, there is an expiration associated with the contract when you initiate the trade. If neither the floor nor the ceiling are touched, it will settle at a price at expiration, and it will settle at a price between the floor and the ceiling, and then that knockout expires. It's over, and at that point you would experience a partial profit or a partial loss depending upon where you bought or sold it and what price it settles at expiration. All right, so we're going to talk a little bit more about that, but I just wanted you to know, let's just talk about this. Let's just summarize quickly, and I think knockouts are pretty intuitive. And if anyone's got any questions, I think I've answered the one question that came in, but if I wasn't clear, please let me know. But a knockout is simply a delta one product. You are trading the price of the underlying. It's going to move directly in price with the underlying. If you think it's going up, you buy. If you think it's going down, you sell. And you've got clearly defined knockout levels, a floor and a ceiling, and you would get knocked out of the trade if it touches the floor or the ceiling. That's it. And yes, that it's similar to an OCO order. If you trade other products, one cancels the other. That's a great question. Thank you very much. It's essentially an OCO. If you're not familiar with OCO, one cancels the other. You would buy a product and then you would offer an exit strategy higher. You would put a price to sell up higher, and you would put a stop loss down below her. And if it were to go down and touch your stop loss, it would try to get you out of the market. If it went up to your exit price, it would get you out at your exit price. The difference between an OCO and a knockout is there is no slippage. So if you're sending a stop loss order and it touches the floor and you trigger a stop loss and it just plummets, you could get filled and you can get out of your position way lower. You have no idea. With a knockout, there are no surprises. You know your exit strategy if it hits the ceiling. You know exactly the price, your exit strategy if it hits the floor, and that's it. That is the price. There is nothing else. The contract simply settles and everyone's knocked out of their trade if it touches the floor or the ceiling. Okay, good. I think we're pretty clear there. So let's talk about how they work. We do set our knockouts at the beginning of the week, and they're set for a duration of 1 week. So we start the week and you'll have knockouts that go out a week. Now, what's going to happen? During the course of the week, and we will initially list 4 knockouts for a contract, the price of the underlying is going to move and it will start touching some of the knockout boundaries. In the event that one of the floor or ceiling is hit on a particular knockout, that knockout expires, it settles, it's over, and a new knockout will be listed. So you start with 4 and 1 gets knocked out, you'll have 3, we'll add another one. So generally speaking, you're going to usually have 4 unique knockouts to choose from. As the week goes on, knockouts will settle, will expire, and will list new knockouts. So here's an example in gold, just so you can visualize it. Gold starts the week at $18.20 an ounce. And we initially list 4 knockouts. And you'll notice we put them all at very distinct levels, so they are stacked. Knockout number 1 is going to have the lowest floor and the highest ceiling. Knockout number 2, the ceiling comes down a little bit and the floor goes down a little bit. The range is the same. It's just a slightly lower with slightly lower levels. Same with knockout number 3 and knockout number 4. Now let's take a look at what were to happen as gold moves around. Now here's that 1820 level. Here's right where gold started the week. And then we've got expiration at the end of the week. That's the red line. Here's where if it doesn't touch a single one of these at the end of the week, it will settle at a price. But let's take a look at what happens as gold moves. First, in this first example, gold starts trading higher. Now, as gold trades higher, knockout number 4 has the lowest ceiling, and we touch that ceiling. Boom. Knockout number 4 is settled. It expires. Anyone in that trade is knocked out. If I had bought a gold knockout, I'm not sure why you would buy that one, but if you bought that gold knockout and it touched the ceiling, boom, you made a little bit of a profit, you're knocked out of your trade. If you had sold this knockout, the price went up, it went and you got knocked out. You went the wrong way. You sold it, it went the wrong way, and you got knocked out for your maximum loss. Now, when that knockout is gone because gold was going higher, we would add a knockout to the higher range. And as you can see, if you were to rearrange these, we would have 4 knockouts again, where you've got differing levels of ceilings and floors to give you a variety to choose from. Now, if we go through the same example and gold were to go lower, obviously knockout number 1 has the highest floor. So knockout number 1 is the first one that would get knocked out. So if you had bought knockout number 1 looking for gold to go higher and it went down and touched that floor, oops, you were wrong. You got knocked out and you're out of your trade. And then we would add a new knockout down below so that we've always got those 4 knockouts. Now let's talk about time-triggered settlement, right? And we actually call knockouts a variable payout contract because you don't know what the profit or loss would be on any given position because it's determined by where you enter the trade. You might buy or sell at a different level that someone else buys or sell. And then the final settlement of the contract, it's either going to knock out at one of the levels or it goes all the way to expiration. Now, this is that same example, but we've just gone to the very end of the week. And when these knockouts were listed, the floor or the ceiling was never touched in any one of these contracts. And so at the end of the week, we'd have these 4 contracts and gold would settle at a price. We hit that expiration at the end of the week and boom, it's going to settle. And at that point, whether you had knockout 1, 2, 3, or 4, it doesn't matter. Your profit or loss would be determined between the price that you bought or sold it and the settlement price. So if you bought it and it went a little lower, but you never got knocked out, you never hit the floor, so you didn't experience maximum potential loss, but you would have a partial loss. If you had sold this knockout and it went lower, all right, but it never hit the floor, so you never got maximum profit, but if you sold it and it went lower, you would have a partial profit at the end of the week based upon where you sold it and the lower price that it actually settled. So let's talk about knockouts, the risk and reward, and this is one of the reasons why we have 4 knockouts. There are 2 reasons why we have 4 knockouts, and I will explain that. But number 1, the reason we've got multiple knockouts is because the maximum risk and the maximum potential reward is known before you place the trade. And essentially what we've done is we've built an inherent trading plan in a product. This is something a lot of traders are taught is when you get into a trade, have an idea of where you would stop your losses and have an idea on where you would take your profits. At what point would I have had enough pain? I was wrong. I had an opinion. I took a position. I was wrong. Where do I admit that I was wrong and simply get out of the trade for a loss and move on to the next trade? Or where, at what point do you hit a level and you say, yes, that's where I would take a profit. And you should have that in your mind when you're placing a trade, is where would you get out for losses and where would you get out for profits? Well, with the knockout, we have baked that into the product itself. The very structure of a knockout essentially forces you to have a trading plan. And it gives you a profit target and a stop loss baked into your trade. So when I buy a knockout, I know that the floor is my stop loss level. I buy it, I think it's going to go higher, but I'm wrong. Now we give you multiple knockouts so you can determine how much risk you're willing to take. How much risk, at what point do I want to get stopped out? How tight? So sometimes people will look to buy a knockout that is closest to the floor with very, very tight stops. I'm wrong. I want to know sooner rather than later. Others might choose a different knockout because they're willing to take a little bit more risk. They want to have a little bit more wiggle room. But you also have a profit target, and that would be the ceiling when you buy. That is the exact inverse when you sell. But the very nature of a knockout is that you've got a clearly defined profit target or potential profit target and a very clear risk stop loss level baked into your trade, whether you're buying or whether you're selling, and it's given to you because it has those hard knockouts at the floor and the ceiling. Now, I like to put this up, and the reward side is one thing, and we're going to pin that up to the side. But what's really important is your risk. Your risk, and this is the second reason why we have multiple knockouts. Your risk is, if you're buying, the maximum risk you've got is the price where you bought down to the floor. And if you're selling, your maximum risk is the level you sold up to the ceiling. Right? So you know, getting into a trade, what your maximum risk is. And this is what a lot of successful traders do, is they manage that risk. And it's up to you to determine how much risk are you willing to take on a trade. Now, I'm going to go through a buy example and a sell example on where you would look to manage your risk. Now, if you were buying gold, for example, and here is that same setup that we had earlier, which knockout might you choose if you were buying gold? Now, if you wanted to limit your risk and take the least amount of risk, you would choose knockout number one. Why is that? If I thought gold were going higher and I wanted to buy it and I wanted to limit my risk the most, I would choose the one with the highest floor. So if I were wrong and it were to be go down, that's where I would be knocked out. I would stop my losses. Oops, it doesn't matter how much lower it goes, I'm knocked out of the trade. Now, of course, you're knocked out, and if you get knocked out and it were to turn back around, you would have missed an opportunity, which is why some people choose and they're more comfortable with, say, knockout number two to give them a little bit more wiggle room. More on that later. But if you wanted to, and this is my premise, limit the amount of risk you had to the smallest amount, knockout number one would have the least amount of risk if you were to buy it. Now, I want to visualize this because this is that whole risk versus reward ratio. And this is why we offer multiple knockouts for people to choose which one suits their risk profile. So here we are with that gold at 1820, and I know that here's where the trade is on the black line. This is where we are now. I know when expiration is. I know the floor is down below. This is that knockout number one. I know where the ceiling is up above, and I'm buying this at 1820. And so it's very easy to sort of visualize what my risk is to my reward, and the risk is the red area. That's how much risk I'm taking. If I were to buy gold and I thought it were going higher, I know exactly how much risk I have, and I see what my potential profit is. And that ratio, the ratio between the green and the red, is up to you to decide how much risk are you willing to take for what type of potential reward. And with 4 knockouts, what you're going to see is that if I were to have bought knockout number 2, the red would be a little bit bigger and the green would be smaller. And that would be incrementally. And which is why if you were to think of this as knockout number 4, where the the ceiling were really, really low and the risk were really big, you would see very little potential profit with lots of potential loss, which is why I said, why would you be buying that knockout? You might be better suited buying a different knockout, but you've got a variety of ranges. Now, the reason we've got all those other knockouts is you're not only potentially buying, but you're potentially selling. So let's take a look at, all right, here's where gold is now at 1820, and I wanted to take a short position. I think gold is going lower. I might choose the knockout. If I wanted to absolutely minimize my amount of risk, I would choose the knockout with the lowest ceiling. The lowest ceiling. I'm selling it, so I would choose the one with the lowest ceiling. The one with the lowest ceiling is knockout number 4. So if I were to sell, if I thought gold were going lower, I might choose selling. And here's what this looks like for me selling. All right, so I know the ceiling is up at 1830. I know the floor is down at 1880. And so if I were to sell and it were to go up, I know where I would get knocked out. I would get knocked out up at the ceiling. And if it were to go down, I were correct, there would be my profit. Look at my risk reward ratio. It is different. This is knockout number 4. So this is why we've got different knockouts based upon whether you are buying or whether you're selling. You can control the amount of risk in your trade. All right, so I think that's pretty clear there. Now, the other big reason for having 4 knockouts is your capital requirements. The very first thing people will often ask here is, how much money do I have to have in order to trade a knockout? And the amount of money that you need to put up is your maximum risk. This is why I keep hammering that maximum risk. You know what your risk is right up front. If I'm buying, I know it's down to the floor. If I'm selling, I know it's up to the ceiling. I can't lose any more than that. That is the amount that you need to put up for the trade. That is your capital requirement. And what's interesting is that number will never change. Once you've put on a trade, you knew the maximum you could potentially lose. That is what you put up for your trade. And there are simply no margin calls ever. So something very different when you're trading, say, futures contracts, where you put up initial margin and then you might get maintenance margin, and volatility could change, and the exchange can or the clearinghouse can mandate additional capital calls. All of that goes out the door with knockouts, because you knew what your maximum risk is before your trade, and that's what you put up to do the trade. You will never get a margin call at Nadex, and you cannot lose any more than you initially put on a trade. And that doesn't matter whether you're buying or whether you're selling. It is always known up front, and that doesn't change. And so that is another reason why we all offer multiple knockouts, is that you can choose how much capital you're willing to put into your trade by always choosing the minimum capital requirements. You can manage your trade capital by choosing knockouts that have the least amount of risk. So that is how people manage. If you have a smaller amount of money to trade with and they use knockouts, they'll use knockouts with the least amount of risk for what they're trying to accomplish. And that way they're able to trade around their capital and use what capital they have. You don't have to put a whole bunch more into the market. So any more questions on knockouts? It doesn't look like it. I think I've gotten to them all. I think knockouts are pretty straightforward, and I think they're pretty intuitive. As a Delta One product, you buy if you think it's going up, you sell if you think it's going down, and you have these clearly defined knockout levels. If it were to go either your way or against you, and either you'll recognize maximum profit or you'll experience maximum potential loss. Right. And you can manage how much capital you have in the market, how much you're trading with, by choosing knockouts that have the least amount of risk, whether you're buying or whether you're selling. Now, if you understand, oh, and by the way, I do want to go through a quick order ticket, because if you understand knockouts, you're going to understand call spreads, is what I was about to say. But here's an order ticket. It's pretty straightforward. Here's an order ticket for crude oil. And at the time, crude oil was trading at 70.62. And this knockout was clearly taken on a Tuesday, because there's 3 hours and 3 days and 18 hours to go, because they're weekly contracts. So there's plenty of time left here. Remember, it's a Delta One product. I do have my floor and my ceiling clearly identified for you. 66 and a quarter, 71 and a quarter. I've got my range with my floor and my ceiling. And when I go to the charts, it'll be even easier to understand this. There will be a bid-ask spread. All right, if I wanted to buy or sell, I thought oil, and this is an example of me thinking oil, we're going to go lower. All right, notice how it's just under the ceiling. The ceiling is 71.25. I'm taking a short position. I think oil's going lower, and it's currently trading at 70.62. Now, I can place an order between the bid-ask spread. Notice here I'm trying to sell, it's red. If I were trying to buy, the buy and the blue would be lit up. Now, can I place an offer to sell between the bid-ask spread? Yes. I can place my offer at 70.61. Am I guaranteed to fill? Absolutely not. But I am allowed to put my order in, and somebody else in the marketplace may want to trade with me. If I really wanted to sell one, I would sell it right now on the bid at 70.59. And I know I would get a fill, because I'm only trying to trade one. Now, if I were to sell one at 70.61, if we give this math to you right on your order ticket, if I sold it at 70.61, so someone else bought it from me, and I were wrong and it went up to 71.25, I would get knocked out for my maximum loss of $64. Now, if I sold it at 70.61, I got filled and it went down, and it went all the way down to the floor, 66.25. It went all the way down to 66.25. I would experience maximum potential profit of $436. It is a Delta One product. I think oil's going lower. I sell it. I know I'm knocked out up above. I know I've got a profit goal down below. All the math is done for me on the ticket. All right, now let's talk about call spreads quickly. And the reason I say call spreads, understanding call spreads, once you understand knockouts, understanding call spreads is pretty straightforward. So let's go through a definition of a call spread. And a call spread is also a contract that also has a range. And that range also has two levels, also called a floor and a ceiling. Sounds familiar, doesn't it? So call spreads are very similar to knockouts. The value, though, of a call spread will move in line with the underlying market, similar to knockouts, but not the same. And there are two very, very distinct differences with call spreads versus knockouts. So let's talk about those two differences. All right, so the first difference is that a call spread only expires at expiration. There is no price triggered settlement. Let me repeat that. A call spread only expires at expiration. So if I were to buy a call spread and it were to touch the floor, I am not knocked out. I am still in the trade, and I have time to potentially be right. So if I buy it and it touches the floor, I am not knocked out. I have time. It still could potentially turn around and go higher. So I have optionality when I'm trading call spreads. Conversely, if I were to sell If I were to sell a call spread and it were to go up and touch the ceiling, I am not knocked out. I did not experience maximum loss yet. I've got time for it to potentially turn around and go lower for my opinion to be true and for me to potentially profit. I've got optionality. Now, that optionality also works the other way. If I bought a call spread and I were right and it were to go up to the ceiling and it went through the ceiling, I am not knocked out. All right. I am not knocked out. It could potentially turn around and go against me. So that I am now let's pin that concept up to the side because there is a big reveal in 2 slides and it's really important to know this. But you are not knocked out of a call spread. There is optionality involved. If it touches the floor or the ceiling, you are still in the trade one way or the other. Now, the other thing that makes a call spread different is because it has that optionality, because you don't have these hard knockouts, volatility will be factored into the price of a call spread. There is going to be a premium for a call spread. All right, so the price of a call spread will not be the same as a price of a knockout. A knockout is a Delta 1 product and it moves directly in line with the underlying. A call spread will move in line with the underlying, except volatility and time to expiration will impact the price of that call spread. So there is going to be that premium value baked into the price of a call spread when you trade call spreads. And that is important to understand. There is no price triggered settlement, only time triggered settlement. It will settle at expiration. So hold that thought because it's going to get, I know there's a question that's going to come in, but before we jump to that, I wanted to quickly walk through an order ticket for a call spread, and it looks very similar. Here's a call spread for crude oil. At the time, it was trading 70.60. There was 18 hours left in this call spread, so just shy of a day. It had my levels 65 and 70. So there's my floor and my ceiling. And look, here's one again where I'm trying to sell. All right, I'm trying to sell, and I've got a spread in here. Notice that the price of, if I'm selling, the indicative price is up at 70.60. But if I were to sell this, I would have to sell this down at 69.70 something. That's that premium. I'm having to sell it lower. If I were buying a call spread, because notice this is above the ceiling. The ceiling is 70 and it's above the ceiling. If I were trying to buy one below the floor, I'd probably have to buy higher than the current indicative price. And I'll show you some examples of that. I'll show you some examples. But here I'm trying to sell, and I can again put an offer in between the bid-ask spread. We have a central limit order book, meaning anyone can put a bid or an offer. It's first come, first serve. It's price, time, priority. So I can place a bid between the bid-ask spread or lower. I could place an offer between the bid-ask spread or higher. But here in this call spread, I'm trying to sell one at 69.73. And if I sold one at 69.73, I know that I cannot lose any more than $27. I cannot lose any more than 27. So if oil were to go higher and higher and higher, I can't lose any more than $27. Now, what could I potentially make? $473, but oil would have to go lower. And if it went all the way down to 65, remember, if it went down and touched 65, I am not knocked out of the trade. I'm still in it. I would have to buy it back to lock in any profits. And that is what the big reveal is. This is an important rule when trading knockouts, okay, or call spreads. Just because there's an expiration associated with the contract does not mean you have to wait until expiration to see what happens. That is so important that I'm going to repeat that, and I want to leave it up there for a second. When you're trading knockouts and call spreads, and this is true of binary options as well. So if you take nothing away from any of my presentations when I talk about our products, this is really really important. Just because there's an expiration associated with the contract does not mean you have to wait until then to see what happens. You can choose to exit your position early. That is your choice. You can choose to exit the position early. Now, why would you want to exit a position early? And you would exit a position early for one of two reasons. One, you would exit to lock in a profit. And that's really important with call spreads. With knockouts, if you buy a knockout and it goes up to the ceiling and you get knocked out, you're out of the trade. You got maximum profit. Thank you very much. You buy a call spread and it goes up to the ceiling, you are still in that trade. And it could turn around and go back down and all your profits could disappear. So what you could do if you're trading a call spread, if you bought one, you might want to put an order higher to sell it so that if it were to go up and you experienced profit, you could, and you walked away from your computer, you had to go get a sandwich or a cup of coffee or whatever it is, go to the grocery store, and it went up and you weren't there to physically get out of the trade, you could just place an order higher, and if it got up there, you would sell it and you're out of your position and you experienced a profit. You bought it, and if it went down and touched the floor, hey, you bought it, you're still in the trade. But if it went up, you're going to want to probably exit your trade for a profit at some point. The other reason would be to limit losses. You can limit losses. Just because there's a maximum loss on knockouts and call spreads doesn't mean you have to experience maximum profit or maximum loss. If I bought a knockout or a call spread, let's say I bought a knockout and it starts going down, 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 do I have to let it touch the floor to knock me out? No, I could simply just sell it out, experience a partial profit, all right, and just say I was wrong, and I want to get out of the trade and I want to reassess. You don't have to wait for it to hit the floor and knock you out. You can choose to exit a position early and take partial losses and minimize or limit some of your losses. At the same token, you could take partial profits. You don't have to wait for it to go all the way. And that's actually important with knockouts too, is you might choose a knockout with a very tight floor if you're buying it, or a ceiling if you're selling it, for tight stop loss. But if it starts going your way, your exit might not be all the way to the floor or ceiling to get maximum profit. Your exit could be someplace in between where you would lock in a partial profit and be very happy with your trade. So you can exit positions early. I cannot emphasize that enough. Okay, with that, if there's any more questions, I think I got to everyone's questions, please email customerservice@nadex.com. I would also recommend that you follow us on social media, and in particular, take a look at our YouTube channel. Go to YouTube, search for Nadex, and I would say subscribe to Nadex. The recording from this will be available on our YouTube channel. It'll also be available on our website. And the other thing I like to point out on our YouTube channel is that every morning at 8:45 a.m. Eastern, 7:45 a.m. Central, we do a live stream. And we look at potential hotspots in the markets for the day. We're not making any trade recommendations, but we take a look at all the news that happened overnight, what news is coming out for the day. We take a look at what products, where is the volatility? Traders love volatility. We look at where the volatility is, we analyze charts, and we look at knockouts, call spreads, and binary options, and we just talk about them to kind of focus or help traders focus on where those hotspots are, because it might be in a market or in a product that you're not necessarily looking at. So if you subscribe to our YouTube channel, you'll see where our live streams are. You can set up reminders, and we do that every day for about 15 minutes. It's 8:45 a.m. Eastern, 7:45 a.m. Central. All right, and then on those order tickets, I'm going to show you, because people are wondering how potential profit and loss were calculated. let me jump over to the platform and I'm going to show some, because we've got a couple more questions that are coming in, and I think it'll become very clear or abundantly clear once we get onto the platform. By the way, here's the Nadex website. And if you were interested, you could actually see the analysis that we did this morning. And in the mornings, this button will say, hey, watch the upcoming one. If you click on it, this was, this was the one from today. Okay, you could watch it if you want, or you could jump over to this will link you out to our YouTube channel, and you can watch it there. You can watch the ones from back. And in the mornings, we'll actually have, hey, catch the new one, and it would take you out and get you ready for the live stream. So we do make it easy for you to find it. It's right here on our homepage. Now I am going to log in to the Nadex, and I'm going to go into a demo environment. Okay. And if you don't have a demo account, I recommend that you have one. I'm going to log into demo. Your experience in demo will not always be the same as your experience in a live environment, because there are different people doing different things in demo, and a live environment, it's real money. So people behave a little differently. Let's start with a knockout. And I'm going to click on knockouts up here, and you can see we have knockouts on indices, foreign exchange, and commodities. And let's go ahead and take a look at commodities, since we were just talking about them earlier. And let's take a look at, why not? Crude oil seems to be the volatile one for the day. And you see that we've got 4 knockouts. There's always going to be 4 knockouts for any of our contracts. Now, when I click on any one of these, it doesn't matter which one I did. And the reason it doesn't matter which one I did, and I'm going to clear this out of here too so you can see my charts. And I'm going to make this a little bit bigger so you can see it, is on our charts, you can see on the left-hand side that we've got 4 vertical blue lines, and they clearly mark the different knockouts. You can see all 4 knockouts very easily. All right, and it gives you the clear range. Now, if I thought oil were going higher, this is the knockout with the lowest floor. And if I were doing that, I would, I would, let's do this. Let's click on the right one. There we go. I am on this knockout. I am looking at buying it. And I know if it were to go down, I know if it touched 74, the floor, that's my maximum loss. And if it were to go up to 79, that would be my maximum profit. How does it calculate these? It is calculating it based upon the price that I'm trying to trade and the floor and the ceiling. So watch, if I thought oil were going to continue going higher, all right, and I wanted to buy, notice how my profit and loss changes by $1 for each penny that I'm changing this. It just does the math for you. It's if I were to buy one at 75.70, I want to put a bid below the market. If I were to buy one at 75.70 and it went down there and I bought, and in fact, let's go ahead and place that order. I'm going to place an order to buy below. I'm allowed to do this. Okay, I'm placing it 10 cents lower. Okay, and you can actually see here's my order, and it tells me I'm trying to buy one at 75.70. It's currently 75.81. This math is, if I were to buy it at 75.70 and it went down $1.70, went down to 74, I would lose 170. And if I bought it 75.70 and it were to go up to 79, it went up, I would potentially make $330. Hold on, give me 1 second. Okay. Now, if I thought oil were going lower and I were to choose, say, a different bracket, and I wanted to sell, I might choose a different one. And if I were to sell, it's going to give me a very clear price on what I could potentially make or lose, and I could see those levels right here. Now, I am going to talk about something, and sometimes people place orders and they get rejected. Okay, if you get an order that gets rejected and you're not sure why it's getting rejected, and it could be in binary options, it could be in knockouts, it could be in call spreads, one thing that you have to pay attention to is how much, oh, look, I actually ended up buying that one, is how much you've got on hold because of open orders. All right, my available balance. What is my available balance? So I just want to show you something. Let's just say I placed an order. Let's click away. Okay, let's just say I wanted to place an order to buy oil down at $60. Oh wait, it's got it. Oh yeah, what? It's got to be at 72.01, right? 72. It's got to be between. It's a 72.50. All right, I wanted to place a buy order at 72.50 down below. You know, let's choose a different knockout. All right, so let's just put 72.50. Here my floor is 74, so 74.10. Okay, and let's say I wanted to buy 30 of them. Okay, it's now notice that that's my maximum loss. Let's say I wanted to buy 500 of them. Okay, if I wanted to buy 500 of these at some, I know my maximum risk is $5,000. When I place that order, okay. Oh, it's going to violate position limits for sure. Okay, so let's just do 100. Okay, I just placed an order. Notice what happened to my available. You could only place orders that would allow you to. Yeah, I'm gonna. This is gonna be hard for me to do with knockouts. With binary options, it's easier for me to do, and I apologize. But the reason a lot of people get orders that are rejected, and the reason they get orders that are rejected. Oh, did my order get rejected? Yeah, my order actually got rejected. Look at that. Okay. Hang on, we're going to click back on here again. Okay. The reason orders get, because you would be potentially violating your account value. How much your buying power that you've got. All right. So if you get an order that gets rejected and you're not sure why it's getting rejected, it might be because you have a whole bunch of open orders, and those open orders are consuming your buying power, in which case you've got to cancel some of your open orders in order to place new open orders. All right. So when you place an order, that money is at risk, and it will impact the your buying power on your account. Yeah, I was wondering why. Let's try this again. I'm gonna see what happens here. Let's just buy 20 of these at 70. Okay, there we go. I've got an order now. I've placed an order to buy 20 of these at 74.10, and notice what happened. My reserve, it consumed 2,000. The reason they wouldn't take my order earlier and my order was getting rejected is because I was putting in an order that was too big and I did not have enough available balance in order to place the order. So I just actually did do it. Now, if I wanted to place an order for another 20, look what happens. My reserved amount keeps going higher and my available balance keeps going lower. If I did this again, I could do this one more time. All right. And now I've only got 730. All right. So I've got all these orders. Buy 20. I'm trying to buy 80 of these down at 74.10. Now, if I tried to do this again one more time, it's going to reject my order. And the reason it's rejecting my order is because I don't have enough available balance to cover it. All right. I couldn't, and so if that were to happen, I would have to start canceling some of my other orders in order to free up buying power. And as I do that, as I free up my buying power, my available balance comes back and I'm able to place orders again. So hopefully that answered the question. I just replicated the problem using knockouts instead of binary options. All right, I did want to cover call spreads real quickly. I know that we sort of went off on a tangent there because I wanted to make sure I answered that question. I apologize. But let's take a look at crude oil call spreads. And again, I'm just going to click on any call spread. Let's move all this away. And by the way, we've got some really cool new functionality that's coming. I'm sort of teasing it up, where you can set a profit goal. So, like for instance, right now, maybe I'd be happy with a profit a little bit higher. Remember, I can place an order to sell it at 76. Let's say it went up to 76. I would take a profit up at 76. I bought it at 75, 70. If it went up to 76, I'd take a profit. I could place that order up above to sell, and there's my order to sell at a higher price. If it goes up there, I'll sell it. Thank you very much, and I'll be out of my trade, and I'll have made a profit. Now, for call spreads, let's go back to call spreads. Let's go back to commodities. Let's go to crude oil. Let's click on any one of these. I'm going to populate my chart. And here, instead of having, you're going to see the range of a call spread highlighted. So if you clicked on different call spreads, you're going to see different ranges that are available for your call spread, and you can choose which one works best for you. If I thought oil were going higher, I might, and notice this expires in 1 hour. If I were to buy this call spread, all right, I would have, here let's say 76.30. If I were to buy it at 76.30, I know I can't lose any more than $5. My maximum profit would be 145. Could I, if it were to go higher, could I buy it? Yeah, I could buy it, but notice that I'm paying a premium. It's currently trading at 75.92. I'm going to have to pay above that because I've got that optionality baked in place, and I'm only risking $5, but I'm looking for it to go higher. Now, if I thought oil were going to go lower, I might choose a different call spread. Let's say I wanted to choose this one, and I thought oil were going to turn around in the next hour. All right, I think it's going lower. I'd have to sell it. Notice that it's trading 75.96. I'd have to sell it down around 75, in the 75.40s. That's that premium. Now, again, I can't lose any more than $3. I cannot lose any more than $3, but it would have to come all the way down to 75.43 for me to potentially start making some money. But I've got that optionality. And if I were to sell this, I might want to place a bid down below to buy it back. If it were to drop, remember, in a call spread, if it went through the floor, I am not knocked out. I would have to physically buy it back to close the position. All right, with that, I think I've answered everyone's questions, and I did go through all of knockouts and call spreads. This recording will be available on our YouTube channel as well as on our website. And again, I would say, please join us. It's 8:45 a.m. Eastern. Every morning we live stream on YouTube. And if you're not able to catch those, those recordings are immediately available, so you can go back and review them if you're not able to join during that time. And it might give you some ideas on where you might want to focus for later on in the day. With that, thank you again for all the questions. I love the interaction. It always makes it more fun when I've got an engaged crowd. And hopefully I will catch you tomorrow morning. Good luck in the markets, everyone.